So many investors destroy their potential returns, and there's really no need for it. I want to get right into it. So, here are some of the biggest ways investors completely sabotage their portfolios. The biggest way that I've found from my experience in life is not having a plan. This is a lot more prominent with newer investors, but an experience from my life, I was literally just talking to my friend the other day, and I asked him what his plan was because I think it's very good to have one. And he was like, well, I like to buy it when I think it's at a reasonable price, and I sell it when it goes up. Buy low, sell high. What more do you need? It sounds good in theory, but in reality, that's just a flimsy shield to hide the fact that you don't exactly have a plan. So while I'm gonna hound him until he figures it out, I can't do the same for you. So I think the first step in this is to figure out what you want your retirement to look like, or what you want your investing to accomplish. Some people may only want to invest for a few years to save up for a down payment on a house or something. I don't know, but most people invest for retirement. And there's tons of videos on the internet you can learn from. Don't just take my word for everything. You can be a value investor if you want to. You can be a boglehead investor. You could be a deep value like Roaring Kitty. Man, that was nuts. I personally am a dividend growth investor. To summarize this, I invest into individual companies that have a consistent track record of paying and growing dividends every single year to eventually be able to live off of those dividends. And there are a lot of things I like. A couple of the major ones are the fact that I don't have to worry about share price appreciation at all or market downturns because, again, I'm only worried about my dividends. And I also don't have to sell any of my shares. I know that was kind of quick, but if that caught your attention, you can delve a lot deeper into it. I have a lot of other dividend growth videos on my channel, but there are also tons of other investing methodologies that I've mentioned earlier. You can do your own research on this. Just develop a plan and stick to it. The next way that people sabotage their portfolios is by FOMO buying or FOMO selling. And honestly, it's really just being too emotional in general. I think it's a tale as old as time. Think about all the people who get to retirement, for example, and then the market crashes like 10 to 15%. They freak out, they jump out, they lose $100,000, $150,000, and then a few weeks later, it's back to where it was. And sometimes it's even further. When prices rise, people chase. When prices fall, people panic. It's an endless cycle, and I could give a million examples. Dogecoin was a big one a few years ago. A lot of people dumped in money, and it went up a lot very quickly, and about just as quickly, it dropped. There was literally that Dogecoin millionaire. He got famous from it, and he didn't end up selling any of it, and he actually ended up worse off than before. And I think this also goes back to having a plan. If you have a plan, it'll help keep your emotions in check heavily. So for that guy, it could have been, I'll get out at this price, or I'll take a certain amount out at this price, whatever. But it doesn't have to exactly be, I'm going to get in or out at this price. You could also just have a general framework. For some people, it may be a classic boglehead approach. You put in a set amount of money every 2 weeks, every week. Sometimes people do it every day. It's nuts. Into a low-cost index fund, and you just wait. For me, I invest bi-weekly every time I get paid, and I look at DCF models, PE ratios, free cash flow yields. I look at several different things, and I kind of just feel out what I think is just the best asset to invest in at that time. And this allows me to not only do I understand the assets that I'm investing in, usually I try to, but I also believe I'm getting in at a good price. So regardless of what happens, this really does take a lot of the emotion out of it. And to give another example, Peter Lynch one time talked about Kaiser Industries. And he was invested into Kaiser Industries, and he said, it can't go lower than this number. And it did. And then he said that again, and then it kept dropping. And he was kind of like, what the hell? But he kept buying because he understood the business, and he understood, like, they own Kaiser Steel. That's really the only one I remember off the top of my head. Kaiser was a big company that was doing good. And because he understood it, it allowed his emotions to stay in check, and he was able to stay invested throughout all the downturn, and it ended up being an insane investment. It did so good. So again, try your best to not be emotional, not experience FOMO. I know it's easier said than done, and I know I kind of just repeated my first point about having a plan, but I think that goes to show how important it is. If you can have a plan that you can stick to, that you're comfortable with, it will help keep your emotions in check. And you're kind of just knocking out two birds with one stone. I know it can be very scary to see your portfolio drop a significant amount in a very short amount of time, but try to think back to these principles and try to just maintain rationality. Some people will talk about boglehead investing and then just putting your money into the S&P over and over and over and waiting because it only goes up, and then it drops a little bit and they freak out and their entire mindset shifts. So again, just try to be rational here. The third biggest reason that I think investors completely sabotage their portfolio is just lack of knowledge and lack of trying to actually learn new knowledge. I know I might sound like I'm repeating myself a bit because I basically just said the same thing in the last example, but people don't understand what they're investing in a lot of the times. And even now, my friend who he's been crushing it this year, they say everyone is a genius in a bull market, but regardless, he's up 30%, and I've helped him with some things, but he's also made his own investments and they've done really well for now. Again, we will see. He might have his own thesis that works, but I've looked into some of these companies and I personally don't like them. And I know that's just my opinion, but when a company's actively losing money, you got to have some extra insight. He'll learn as he grows, but I just wanted to give an example from my personal life. People will invest into things that they don't really have that much knowledge of. And you can kind of do that with some index funds. Like if you just know that the S&P goes up over time, that's fine. It's been proven to work. But even with that, you could still learn more knowledge. One thing that I've been getting into recently is Sharpe ratios. Another major thing is expense ratios. I know that's a little bit more prominent in mutual funds as opposed to index funds. But if you're going to go the index fund route, learn what companies you're invested into. Sometimes people will have a lot of overlap and they may not like that. Learn how they go about investing into these companies and rebalancing. Learn their expense ratios, Sharpe ratios. You can learn these things, and while it may sound like a lot right now, if you just give it like a couple weeks, you will be a lot more comfortable. And from my scenario, people who invest in the individual stocks, they won't look at their earnings, they won't look at their revenue, they won't look at their freaking margins, they won't do anything, and they just buy a company because they hear about it a lot, like Tesla, for example. Tesla may or may not be a fine investment. I don't know. I really don't like it, but it's gone pretty parabolic since its IPO. So what do I know? Maybe I sounded like a broken record a bit, but I really think these are all major problems that a lot of investors face, and they weirdly go hand in hand. So if you can solve one of them, that'll help you heavily in solving the rest of them, and you will overall be a better investor than the rest of the world, to be honest, but overall a better investor than yourself previously. So again, develop a plan and a framework that works for you. Try your best not to get too emotional and learn about what you're actually doing and what you're actually investing in. Your portfolio will thank you. That's pretty much it, but before I end the video, I just wanted to say thank you for 400 subs. I can't remember if I said it in a previous video or not, but I don't think I did, and I know I'm a bit late because I'm already at like 4:30. But I really appreciate it. That Nobody Cares Be Frugal video has blown up recently, and it's really shot up a lot of the metrics on my channel, and it's put me a lot closer to that monetization goal. So again, thank you so much. I really appreciate it. I hope you got something out of this video. If you did, consider leaving a comment, consider subscribing. I'd really appreciate it. Good luck on your investing journey.